Over the last few years, volatility and uncertainty have been a given, and headlines have reflected this. This has also put the spotlight on the big rating companies who play an important role when money is tight and borrowing crucial for survival. In India, the biggest rating agency is Crisil, an arm of one of the world's top 3 rating agencies, S&P. But while most people in the financial world are familiar with it, few realize that it actually started as a small experiment. But it got its timing right.
I think the great thing about Crisil and the great thing about people like Mr. Vagul and Pradeep Shah were they brought in a concept into the country which was way ahead of its time. If you look at it, at that point in time, when Crisil was founded, there was no reason for a rating agency to exist, because whether you were rated AAA or whether you were rated BB, all of you borrowed at the same rate that the government specified. So it was 17% or 18% or 19% or whatever it was at any point in time. In fact, if you were a sick company, you got the benefit of concessional interest rates. So the whole concept of risk-reward didn't exist. In a situation like this, to come in and sell the concept on the basis that you would get an independent third-party evaluation that would help you improve your credibility was I think, an absolutely amazing feat that Crisil pulled off at that point in time.
What was it like that time? Because at that time, the concept of an independent body actually looking deep into books was not there. And God knows Indian corporate structures are pretty complex and pretty opaque for a large part. What was it like breaking the ice?
Within the company, it was amazing. It was a bunch of exceptionally bright people, very charged up, with the pioneering zeal that we are doing something new, we are bringing independent analysis to the market, we are talking about new ways of looking at things. I think until Crisil came into the picture, most of the Indian markets looked at debt to equity as long-term debt to equity. We came in and said you have to look at long-term and short-term debt. We came in and said it's not enough to look at the debt on the books of state governments. You have to look at contingent liabilities as well. So pioneering new ways of looking at things was, I think, gave people a high, the feeling they were doing something new. How we were viewed, I think externally, initially people thought we were just a small company and let us be. In a way, the fact that they let us be, I think, allowed us to be truly independent.
But was there pressure in the tough times? Because pretty early on, you did go through an economic crisis, which was about 96 onwards, where the economy slowed down. Was there pressure?
I think there was pressure. You know, Indian market had never seen downgrades in those days. And the fact that, you know, you wake up in the morning and read the newspaper headline saying Crisil downgrades 18 non-bank finance companies, was a big deal for the markets those days. Was it easy to do? No. But I think, again, I think we had a great committee. We had Ravi Mohan, who was by then the CEO. We had a great chairman in Mr. Vagul. And I think no matter what phone calls they got, they made it a point to see that that pressure didn't get transmitted down to the analysts or the analytical team. And they let us go ahead and do what we thought was analytically right.
All through the 90s, adversity seems to have forced Crisil to innovate, and it began by going deeper and wider into corporate India and overseas. The first steps might have been tentative, but then there were a series of acquisitions and a tie-up that transformed the scope of this small rating agency forever. In 1997, S&P picked up a stake in Crisil. But Roopa believes that the first big turning point came thanks to a crisis.
I think the first turning point for the company was the late 90s. At that point, we downgraded a lot of our clients and lost a lot of our clients. We realized then that in order for our opinions to be truly independent, it was very important for Crisil to ensure that we were not purely financially dependent on the ratings business. And the whole growth and diversification mantra, I think the seeds of that were sown at that time. And then we decided it is important for us to have a diversified analytical platform. It was also important to ensure growth opportunities for our people. It was also important for us to have that platform to have growth for the company. Today, we are at a situation where in 2012, 60% of the company's revenues came from outside India, and ratings is down to about 1/3 of our revenues. So I would count that as one turning point. Standard & Poor's took a majority stake in Crisil in 1995. I think that was very helpful for us as we went global. The backing of S&P gave us a strong parent, gave us a name in global markets that was much more recognized than Crisil, and helped us to grow our business with the investment banks, where we helped them with high-end analytical research. So today we have research centers as Crisil, not just in India, but also in Argentina, Poland, and China. And I think this entire growth outside India, the confidence that having the parentage of an S&P gave us was immense.
But let me understand, what does S&P use Crisil for increasingly internationally? Is there in every industry, Indian companies or Indian arms are providing the very important R&D facility, the back-end facility, the research facility. In that parlance, what is Crisil doing for S&P?
So we have a very large team in India, around 800 analysts, which are supporting S&P in global analytical work. It's a very important part of the Standard & Poor's operation globally. S&P, as you know, has a great focus on ratings excellence, on service excellence, and improving time to market, providing deeper analytics. The need for that has grown after the global financial crisis, and a lot of support for initiatives like that comes out of the Crisil operation.
When you see growth in Crisil, are you seeing it, what is the proportion of growth within India, and how much will it come from a global landscape?
So if you just look at the track record over the last 10 years, both our revenues and our profits have grown at a compound rate of almost 30%. So that's a phenomenal growth rate. If you look at each one of our businesses, they've grown as well. So you look at ratings, I think ratings business, the phenomenal growth has come by going deeper. It has not come by expansion of the bond markets, but it has come by expansion of the ratings base, by making ratings relevant to the smaller companies. If you look at our business outside India, we started off with equity research offshoring. We have now gone on to cutting edge work on the derivatives side, a lot of work on the quant side. To give you a fascinating example, in our research center in Argentina, we've put together a team of 6 PhDs working for a bank in the United States, supporting high-end quant work. And if you look at these PhDs, one is from India, one is from Pakistan, one from Venezuela, one from Cameroon, one from Italy, and one from the United States.
With nearly 60% of its revenues coming from the international markets, Crisil today has quite a spread, with offices and high-end analytic teams sitting as far off as Buenos Aires in Argentina to China. But even as it expands, how bad are things looking for the many corporates it analyzes back home in India? Few would know that answer as well as Roopa Kudva. More on that when we return. Rating agencies have created quite a furore in India, and what they have said has been a reflection of the situation on the ground. In June 2012, there was shock when S&P announced that it was keeping a close watch on India's sovereign rating, and there was a risk that this could fall off the radar if things didn't improve. Earlier, in October 2011, its arm in India, Crisil, hit the headlines when it announced that the Indian banking sector was sitting on a potential time bomb. There were critics who said these agencies were exaggerating the problems. So were they? Are things looking better?
We are not creating new numbers. I think we are just a reflection of what the situation is. And I think whether it was the estimation of the risk to the banking system arising from the power sector, or if you go back into history, the whole contingent liabilities that state government guarantees provided, to the fisc, I think were issues that we've always highlighted. So I think it just continues a tradition of saying it as it is.
Is it worse now?
Well, if you look at the situation, I think there is no doubt that the economy, we've had the lowest growth rate in a decade, and that naturally has its impact on credit quality. However, we believe that if you look at the overall credit quality of corporate India, we think we have bottomed out. It's going to be a long stay at the bottom, though, before the climb up begins. And let me tell you why we are saying so. Today, Crisil has ratings on 12,000 companies. If you look at the ratio of upgrades to downgrades, they are a very good indication of what is happening to the health of corporate India. In the last last half of 11 and 12, the credit ratio was 0.91, which meant we were downgrading more companies than we were upgrading. By the first half of last fiscal, which has just closed, that ratio had come down to 0.66. So there was a steep decline from 0.91 to 0.66. In the second half of the fiscal that has just concluded, year ending March 31st, that number has only gone down to 0.62. So what you can see is that while downgrades are still higher than upgrades, the pace and the intensity of downgrades has declined. So we believe that the number will stabilize at around this level. We will still see more downgrades than upgrades, but the ratio should remain around 0.62. The movement up to the 1 level, which indicates equal number of upgrades and downgrades, I think is going to be quite a while away.
How long? Is it easy to judge that right now?
I think let me talk about what the positives are. Why are we saying? I mean, I think it's no small statement to say that we have bottomed out. And why are we saying so? I think we're saying so for 2 or 3 reasons. One is we certainly expect GDP growth in the coming fiscal to be higher than it was. It was 5%. We are saying it will be 6.4, 6.5% this year, significantly aided by consumption. There's a lot of money in rural India today, which is powering a consumption cycle. And I think that that's going to see that the GDP moves up from 5% to 6.5% or thereabouts. Secondly, interest rates have come off their peaks, and that reduces the pressure on corporate India. And thirdly, commodity prices again have come off their peaks.
Crisil, which has its ear to the ground with data on more than 1,500 companies, believes that while things will get better, the recovery for India and its companies will take time. In fact, in its last update in March, it predicted that India Inc.'s revenue growth, excluding the banking and oiling companies, could decelerate to 6 to 7%. But is the worst over? And what's the road to recovery looking like?
So revenues have not declined in absolute terms, but the rate of growth has declined to 6%. So overall there is growth, although growth rates are lower than we have seen at their peak levels. The second important thing to highlight is that you see a marked difference across sectors. Certain sectors like power, infrastructure, etc., I think, which are investment dependent, you are not seeing growth there at all. And I think those are areas of concern. Other sectors like automobiles, for example, is another area which is stressed. On the other hand, there are certain sectors which are also not very capital intensive, where the story is much better. And these include areas like packaged foods, packaged goods, FMCG, and so on and so forth. I think so you see a better picture, pharmaceuticals, you see a better, so there are pockets where there is very high stress, and I would put the pockets as infrastructure sectors, power, I would put it as shipping. I would also include sectors which have a very high level of debt like textiles in that category. And then you have the less stressed sectors like pharma, FMCG, packaged foods, etc.
But let's get back to power. In 2011, if the potential NPAs from the banking side was 55,000 crores, what is it looking like now?
So if you look at the power sector, the source of stress is coming from 2 areas. It is coming from the new capacity, that's generating capacity that's being put up, because there the fuel linkages have gone for a toss, and it is coming from the distribution entities because they are not able to recover the cost of power. The tariff increases are not keeping pace with the cost increases. The old generation plants and the transmission sector is relatively insulated. If you look at the solutions that are being talked about, the new power sector package has yet to be implemented. I think a lot will depend on the speed and pace of implementation of the proposed restructuring package in the power sector. If you recall, we had a similar one about 10 years ago, the Monte Ahluwalia recommendations. So the new one has to be implemented. As far as the generating capacity is concerned, I think we have serious issues there that need to be resolved, that of fuel linkages, coal availability, and I think they are linked to the general issues of concern about the investment climate in India, which is environmental clearances, land acquisition, fuel linkages. And I think that is the single most important factor which has led to the pessimism that you see around you today.
The prolonged slowdown in infrastructure has hit Indian banking. Over the last few months, most banks that lend to corporate India have had to make provisions for bad loans, and the problems are likely to persist. Making things worse is the massive need for capital these banks face as they count down to the new norms under Basel III.
Our assessment is that the additional capital that the banks are going to require, I think as long as it is tier 1 equity capital, we believe that the banks will be comfortably placed because the government is committed to recapitalization. Where we see an issue is in the non-equity tier 1 capital. As you know, a new category of instruments has been introduced in the form of subordinated capital, which has several complicated features like the ability or the choice or the option, not to pay interest and principal and convert it into equity. We think this is a new category of instrument for the Indian investor. As it is, you have a situation where the bond markets are not developed, pretty unsophisticated, and if you are going to be depending on instruments like this to raise a large amount of the capital that you need for Basel III, we think it's going to be a challenge. Huge amount of investment in development of bond markets, in education of investors is going to be required.
So are we running against time over there?
And
what are the options banks can look at?
I think, as I said, the tier 1 equity capital, the equity capital portion part of it, I don't think there'll be so much of a problem. The government will recapitalize. People can access capital markets and raise equity. I think there's some headroom there. So we don't foresee a situation where matters will come to a halt and banks will just not be able to grow. I think the challenge is a longer term challenge because you have time till 2018 or so to roll it out, to make sure that you're doing enough to create market awareness of and market acceptance for the other kind of instruments that are allowed for calculation of tier 1 capital.
If you were looking at recovery, what is the recovery process looking like from your vantage point right now? Is it going to be a prolonged U?
I think so. I think it would be fair to say so. We are, as you know, forecasting an increase in GDP growth next year. Do we foresee growth bouncing back to the 8-9% level in the next 12 to 24 months? I think that would be tough.
While the recovery will be gradual, experts believe that there are more critical things that need to be addressed if India really has to have sustained growth. One is the development of the Indian corporate debt market, which could be a game changer for Crisil. More on that when we return. Crisil is India's largest rating agency, and interestingly it has grown far beyond its home market. While here in India its biggest growth driver has been the banking system and smaller companies, the SMEs it rates, it's the overseas business that's getting increasing attention. Take research and analytics, where it works with top Fortune 500 companies, but sadly, the one big disappointment for Crisil has been the fact that even 25 years after setting shop, its core market, corporate debt, hasn't quite taken off in India. So what's gone wrong?
I think that's a tough one to say. I think there are a whole lot of reasons, and I think they've been analyzed and reanalyzed over the years. I think the principal issue at this point in time, though, is the shackles on investors. I think the government has taken a lot of steps over the last few years to make it easier for issuers to issue bonds. If you look at the situation a few years ago, making a bond issue was almost as onerous as making an IPO in terms of disclosures and filings and the like. So all that has been considerably simplified. It is much easier for a corporate to issue a bond today than it was 3 years ago. So a lot of the issues are being tackled one by one. The limit for foreign investors in the Indian bond markets has been increased. I think a key issue really remains the shackles on the investors who have large sums of money to invest and who have the longer term money to invest. And this includes the provident funds and the insurance companies. These are the segments of investors who have the long-term money and large corpus of money. And there the investment guidelines or the investment policies are extremely restrictive. If you look at the Employees Provident Fund organization, currently it invests in bonds of just 7 private sector companies.
The corporate debt market needs serious attention in India because this will give companies access to long-term money, something that's woefully missing given that corporate bonds account for just 4% of India's GDP as compared with 70% in the US and almost 50% in South Korea. But despite this door being virtually closed, Crisil has done well to broad base its business and venture far. So what has worked for it and how has it managed to be nimble?
I think what helped was that we had a very smooth leadership transition. I think it was clear for a fair bit of time before I took over as the CEO that I was going to take over, which always makes things easier. I think I also realized that I had a very bright team. So I think the secret also lies in realizing that everyone around you is actually much better than you are in what they do. And so in a sense it makes my job easier because all that it remains for me to do is really bring it all together.
Going forward, as you also almost running a race against time, against a market that is fast evolving. So what's on your to-do list?
Well, I think today we are in a situation where we are very happy with the platform that we have built. I think we are where we want to be in terms of diversification. About half our revenues come from outside India. Half our revenues come from within India. Ratings is about 1/3 of our business. So in terms of the goals of building a diversified analytical platform, I think we have achieved the portfolio balance that we want to achieve. The next step for us is really to take this platform to the next level. And how do I see that happening? I think within India, a lot of that is going to come through the SME route. It is also going to come through a whole slew of new products as the capital markets become more sophisticated. And these are analytical tools in the wealth management space, in the equity research space, and so on and so forth. Outside India, we see a whole new world of opportunities opening up. Look at the banking sector, which is our principal customer outside India. They are faced with a whole lot of new regulation, whether it is Dodd-Frank, whether it is Basel II, Basel III, the focus on capital and the focus on risk. All this is requiring banks to do new kinds of analysis, modeling, stress testing, model validation, which they've never done before. And I think they just don't have the capacity to do it. And that is what is going to create the opportunities for firms like us going forward.
Crisil's story is the story of a small idea backed by a solid team and developed into a concept that has seen the company find wings and go far beyond the mandate that it was set up with. And given the fact that despite the ground cover there is a lot more to do and it has the world as a stage, it will be interesting to see how this company evolves in the years to come.